Welcome to another episode of Global Investors Podcast. I'm your host, Charles Carillo. Today we have Heath Binder. He manages investor relations for LBX Investments, a diversified commercial real estate investment firm that focuses on retail and residential property investments. Heath has 16 years of experience in commercial real estate and financial services. Prior to joining LBX, he managed investor relations for Big V Capital and previously for RealtyMogul.com. Prior, he worked with ultra high net worth individuals in real estate with Barclays Wealth in Los Angeles, and he began his real estate career with Colliers in 2002, and then worked as in equity as a REIT as an analyst at UBS. So, Heath, thank you so much for coming on the show today.
Sure. Thanks for having me.
So you've been in going on 2 decades in real estate and investments. Can you give us a little background, a little bit more in depth of yourself, both personally and professionally, prior to investing in real estate or being involved with firms that are investing in real estate and what you're doing now?
Yeah, sure. Actually, I think I have to update my my bio info, maybe pull it from our site. I mean, I've been in the industry for over 2 decades now, and I started off as a broker. Actually, I've always been pretty good on the phone. I got a job calling. I cold called a New York Times ad, and I got a job as a broker at Colliers in New York back in I don't know, it was 2002. I wanted to get in the industry. I had some family members who were in it. I was a young kid. I didn't know anything. And, they gave me a big blue book and they said, just call everybody in there. And so I did that, and, I didn't make any money, but it was, it was a good way to get my bearings and kind of learn a little bit of the industry, just the lay of the land. And then, what I did from there is I leveraged that into grad school. So I went to NYU's. They have a real estate institute. It's a master's in real estate finance. I went there, completed that at night while I worked during the day. At the time I wanted something that was a little bit more, call it substantive, right? I didn't just want to be making calls. I wanted to actually understand what I was talking about. So I took a job at an appraisal / consulting firm. And then I went and I worked at UBS, did that for a couple of years. Then the Great Recession hit, and, like everybody else, all of a sudden, not like everybody else, but like a lot of folks around that time, all of a sudden we're in 2008, 2009, and I'm figuring out, what I'm going to do next. And I moved out to LA. My then girlfriend, now wife, is from out here. And there just was not a whole lot happening in the real estate business. And I was always pretty relationship skewed. So I took a job in wealth management with Barclays post Lehman. And I did that for a few years. It wasn't really what I wanted to do. I wanted to stay in real estate. And so after that, I went and I took an opportunity at Realty Mogul back in the early days of real estate crowdfunding. I did that for a couple of years, and it was good to meet a lot of people and kind of hit my stride. But really what I wanted to do was be on the private side. One of the challenges with the crowdfunding model is, when you're on the front end of it, you're talking to investors and they're asking about deals, but you're really an LP. At the end of the day, you're an intermediary LP, and you're not actually doing the deals. So I would go and talk to people about a deal and raise money for it, and then they'd call me up, 6 months later and ask me for updates, and I have to check with our asset management team. It would check with the with the sponsor, who would then get me it was not direct enough for me. I really wanted to be on the side that was controlling things. And anyway, so I went and I joined it was an offshoot of a called Small Family Office on the East Coast. Joined it with a friend of mine and then his former colleague. And that's Rob and Phil. Those are the guys who run LBX. And then when they broke off to form LBX in 2018, I went with them. And since then, I've largely been doing the same thing. My role here is I raise money for specifically equity for our real estate deals. and raise it from a whole lot of different kinds of capital partners, ranging from small guys writing $50,000 or $25,000 checks all the way on up to funds and institutional groups that are writing significantly larger investments. And my role is to continue to build out our network of equity partners, and then also I oversee all communications infrastructure related to investors. So all of our investor reporting, which is often an asset management, that's often that asset management function, but I oversee that. Actually write the reports. One of the maybe differentiators about me is a lot of folks in the IR seat, they don't have that deep of a real estate background, whereas mine goes back pretty far. And and I've underwritten deals, and I've conducted appraisals, and done a lot of the analytical work that it was just a little bit uncommon for folks in IR to have that I'd say breadth of skills. So anyway, that's me in a nutshell, and here I am. So as far as LBX goes, since 2018, we've acquired close to $1 billion in real estate. Most of it's been retail. We're a little contrarian, so when the whole world was going after multifamily, we we didn't like the valuation so much. Kind of scared us. We didn't ever want to take interest rate risk, and it just felt like gambling. So we didn't touch anything in the multifamily space, even though we all have a lot of experience in it. But we saw real opportunities in retail. We continue to see interesting opportunities in retail. It's a very deeply misunderstood sector. And but then last year we started dipping our toes back into multi again. We bought a couple really interesting deals, and we're able to take advantage of all the dislocation that's been happening in that sector. And we're continuing to look at deals in both sectors. We just closed a really interesting deal in San Diego. Our deals tend to be a little bit more nuanced. We look for really good real estate that has either been mismanaged or you've got some sort of selling pressure on the sell. Is just some sort of pressure on the seller that creates a good buying opportunity for us. And that's a lot of what we've done particularly over the last few years. We bought a portfolio of assets from a REIT that was being forced to liquidate. One of the multifamily assets we bought was from a developer that needed funds to deploy into other projects. They had to sell it, and just things like that. And it's been good. How's that for an intro?
Yeah, it's fantastic. So as you kind of went into my next question about your investment strategy at LBX, and you said it's residential, it's retail, but I want to dig a little deeper into retail, because in my kind of research for this episode, one of the things I found is you guys considered neighborhood and community shopping centers being one of the most misunderstood real estate sectors. I imagine real estate sectors in general, and then also definitely within retail, that people don't really, I guess, spend much time or understand how they can be good investments. Can you break that down a little bit about how neighborhood and community shopping centers kind of are a unique place within the real estate sector?
Yeah, I mean, so when you look at retail, there's a lot of different kinds of retail, kind of going from small to large. At the one end of the continuum, you've got single tenant assets, and you've got strips, all the way on up to malls, right? These gigantic malls. And we don't buy malls, but I think what happens is people tend to lump all of retail in with each other. Maybe one consistent theme with retail is people, particularly in this country, they like to shop. They like to shop in stores. They always have liked to shop in stores. And so, if I think about retail, I think about some of the selling objections that we faced over the years. This has been dampened a little bit, but we used to get a lot of pushback on the Amazon effect, right? A lot of people that were concerned that Amazon was going to come in, and we were just going to end up in a world where we never leave our house. Then COVID hit, and people were concerned that retail was going to forever change, and certainly had some impacts. But again, the consumer is pretty hefty force in the U.S. economy. And to your specific question, people do like to shop in stores. And when you think about, what a neighborhood or a community shopping center is, it's typically maybe you have a grocer, or, maybe you have some smaller tenants coupled with maybe some shop tenants. These are centers that we go to conduct our daily business. There's one right down the street from me. It's a Whole Foods with a CVS, and there's which just moved in, a DSW shoe warehouse, which, I don't shop there, but it's always pretty busy. And, I think what you've seen with retail is, there was the Amazon issue, and then there was also, I mentioned COVID, but there's also been some high profile bankruptcies. And you certainly do have to be careful, right? Like when you're evaluating a retail opportunity, how you think about risk is really important. I think that's an area that we're really strong. I'll give you an example, right? We have a deal that we bought in New Jersey, and the whole market looked at it. This is back in, 2022. It's the end of year 2022. And has a Burlington that's, 60,000 square feet. The whole market looked at it and, was spooked by it because, it was a 60,000 square foot Burlington anchor, and, their footprints these days are more like 35,000 square feet. And the market was just kind of scared that Burlington was going to leave. But, with our due diligence, we went in, got really, really comfortable with the performance of the store, and we have good contacts at Burlington. And we're very comfortable that they wanted to stay, but they were also going to want to downsize. So when we underwrote that deal, we didn't underwrite them leaving. What we underwrote is that we were going to be able to, negotiate, a downsize for them. And we underwrote, spending north of $1 million to chop their space basically in half. And then we assumed, because this is the most conservative way to think about it, we assumed that we were going to basically mothball the space next to them. And we've been executing on that plan. In fact, what we've done is we've gotten other retailers to come and take space at the center, more quickly than we originally anticipated. And what drives all that is it's really good real estate. And so when you think about retail, right, it's got certain characteristics. Retail, the best retail tends to sit right in the heart of town, right, in what we call a retail node. It's going to have good traffic counts. It's going to have good visibility. It's where we all go and shop. Right. And that's typically what we look for. We look for what we think is the number one or two best center in a good market. We like to see some growth in the market. And if we can buy a center that's, to some extent been a little bit mismanaged, or undermanaged, and we can buy it at a good basis, then, what we've seen over the years is we've been able to, generate, pretty attractive returns for our investors.
So Heath, what does a typical value add kind of business plan look for a neighborhood shopping center? Whereas with multifamily, something like this, you've got let's say shorter term leases. They're not going over 1 year in most situations. So it's easier to kind of roll tenants, you're increasing tenants' rents, you can really value out a property within 24, 36 months in most situations to the majority of the property. What do you really see what is a business plan when you have longer term tenants, maybe several years left on their current leases? Like you said, you had to work out leases with someone that was downsizing. How does it really work when we go into it to see where we can, grow value, grow NOI?
Yeah, no, that's a great question. So this is not always the case. If you have a large box space, like we have bought centers where there's a large box space to lease, but if you have somebody that's in place in a large box, what you're effectively doing is a credit analysis, to determine whether or not you're going to have an opportunity to re-tenant that. Because if it's, say you have what's a good large credit? Say like a Hobby Lobby or something, like a really, really strong retailer. Say they're in your center and they have, 10-year lease and, a bunch of 5-year options after that. you're not going to get growth from that box, right? You're going to get a lot of other things from that tenant. They're going to attract shoppers, and they're going to bring stability to your income stream, credibility to your rent roll, et cetera. But that's not where you're going to get your growth. But sometimes, we bought, for instance, we bought a deal in suburban DC in Northern Virginia a few years ago, and that deal when we bought it had a really large box, and we're working on we're just about to put a large tenant in there, knock on wood, and that was the primary business plan for that asset, right? So every deal we do is deal by deal, and I just want to caveat that up front. But your two main areas where you generally are going to see some value creation and more of a pop in retail are, one is shop space leasing, and the other is arbitrage. So arbitrage is pretty easy to understand. If you think about a typical center, you're going to have the shops that are sort of set back from the street, and then you're going to have shops, or you're going to have boxes that are closer to the street. So think like that Starbucks that's got a drive-through that's out by the road. So the real estate that is out by the road, those are called outparcels, and quite often you can carve those off, and they trade in the single tenant market, predominantly the 1031 investors, or institutions, and they tend to trade at tighter cap rates than you buy the whole center for. So the simple example is, we bought a center in Orlando. This was back in 2018. It was the first deal we did as LBX, and it was an Academy sports anchored center. And Academy at the time had some credit issues, so we were able to buy the center, even though it was a great location. We were able to buy it at a little, I guess it was around a 9 cap, like 8-9 was our cap rate on that. So there was a Taco Bell out on the street. We carved that off and sold that off. There was a check cashing chain, which is a big private company in Florida. Anybody out of Florida doesn't know it, but in Florida, it's very reputable. That's having a really big corner with 100,000 cars going by. We're able to sell that off sold that at like a 5.5 cap, something like that. And then we brought in a Jollibee's, which was basically like I think it's like a Filipino McDonald's. I mean, it's a very rapidly growing international fast food chain. We brought them in for one of the outparcels and sold that off at, I think it was like a 4.3 cap rate. The cap rates have, come up a little bit. Obviously, the world in 2018 is much different than the world today. But the main point is that when you can buy something at a 9 cap and sell off pieces at a 6 cap, that's accretive. And so we like those outparcel plays. You basically are really doing a couple things, right? They give you the opportunity to play that arbitrage game. You're returning equity to investors, and then you're also paying down some debt. So you're deleveraging the asset. So you're improving your basis, deleveraging, de-risking the overall profile of the deal. That's something that we like to do, and we've done a lot of it. We've returned a lot of capital to investors over the last several years utilizing that strategy. The second is shop leasing. And shop leasing, maybe the simple way to think about shop leasing is technically shop leases it's anything that's 10,000 square feet or smaller. But, generally speaking, you're looking at stuff that's 5,000 square feet or smaller. And these are the mom and pop tenants, and sometimes they're national chains, right? That, like a Jersey Mike's or something like that. But these are restaurants, hair salons, nail salons, yoga studios. This is like the fabric of retail. This is the stuff that, a lot of what's offered in shop space, you can't replicate it online, right? You can't go get your I guess you could have someone come to your house, but you can't go and get your hair cut, on Amazon. That's not how it works. So, shop tenants tend to pay more on a per square foot basis than a larger anchor. So say, you have 2 boxes, right? One is 20,000 square feet, and then the other is a cluster of shop spaces that, is equivalent to 20,000 square feet. So maybe I get, national tenant like a TJ Maxx or a Ross in the 20,000 square foot box. They're going to pay a lot less on a per square foot basis. Now there's a trade-off, right? They're great national credit tenants. They bring a lot of shoppers to your location. But you got that 20,000 square feet of shop space that's aggregated, and I might get double the rent for that. And also, by the way, those tenants are going to have a lot less requirements and restrictions and a lot less control provisions in their leases. So, we love to buy a center where, let's say we'll buy it from an institution. Institutions tend to be really, really good at bringing the large tenants, but they don't actively manage the centers the way that we do. So let's say we buy a center and maybe it's 90% leased, but there might be 10 or 15,000 square feet of vacancy in the shops. And that's where we strike, right? And our model is we tend to work with local leasing partners, and what we really want to see is that they're really aggressively canvassing for, like, we have a very active outbound approach. We're not just sitting there we're not just like casting a rod and like waiting for, someone to take the bait. We're actively out there looking for tenants to fill the shop space. And that's really, really worked. It generates a lot of NOI growth. And also what's nice is, on the back end, when you go to sell a center, you're generally getting, you're getting capped on, who your bigger name tenants are. So if I have a grocer, right, or a national name brand tenant, that's what the buyer is going to look at on the exit before they're really digging in on the shop space, and that's really what's going to set the cap rate. And so that income that you're generating from the shops, it's going to go along with it, and it's a really great way to create value.
Do you have money sitting in the stock market and you're worried about it, or worse, you have money sitting at the bank not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners, and since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. 85% of total retail, like you were talking about before, is still completed in store today, even with what we went through with COVID and stuff like this. And I'm not sure, how they came to that number, but what are you seeing when in your centers, where are there different requirements that retail tenants are requesting? Because now, we went through COVID and everybody was like really pushing online ordering, delivery, all this shopping, everything like this. What has changed? Have there been different requirements that some of these national anchor tenants have come into and say, like, oh, we need more parking here, or we have different requirements for how the building is going to be, for that TI, tenant improvement, how it's going to be done so that it can fit more for people that are ordering online? Or has it been pretty, normal over the last so many years, where it's just that they kind of worked around what people online ordering or anything like this? I'm just seeing, what kind of changes they're having, that really how you guys are marketing a property, a space, if that's different at all with what people are really looking for, companies are looking for to be in that anchor tenant spot. Yeah,
it's a good question. I don't want to get out over my skis on it because, I certainly have enough leasing knowledge to be dangerous, but it's really a question for our leasing team. I don't think that there have been significant changes in terms of the requirements that the retailers coming to us have, but I don't know. I'd say where we've seen a big change versus prior to COVID, and this is not a reflection necessarily of changing preferences of retailers, changing requirements of retailers, just overall costs have come up pretty significantly. And something that we did, we brought on a guy who has a very deep construction management background, and we brought him on a few years ago, and he's been really, really helpful in terms of helping us navigate modern requirements for retailers. But in terms of giving you like a specific answer as to whether some retailers are, requiring, I don't know, ghost kitchens or different parking, additional parking or some other call out that's tied to how they've changed their model in response to COVID. I don't know the answer.
So you mentioned before about, if you're taking over you're purchasing something from an institution, and I think everybody's been inside one of those kind of shopping centers, and it kind of looks like a ghost town. There's a lot of vacancies, stuff like this. It's just, I don't know how they market it or what their kind of business plan is behind it. And you guys say you have LBX is taking like a different approach where you're a little bit more aggressive. Can you talk a little bit about how being, I guess, your property management / leasing, having that in-house or doing it through kind of third-party property managers, and how that really differs in returns to your investors at the end of the day?
Yeah. So first off, we don't buy ghost town retail. There's certainly a lot of bad retail out there, and it sounds like I don't know. It sounds simplistic to be like, this is good, this is bad. It sounds like something out of a I don't know, a cartoon or something, or Star Wars, right? We have the dark side of retail, but realistically, we try to buy good retail, right? You want to get the stuff that's really centrally located and that is going to attract demand, right? And there's been something that's really important to understand about retail is there's been no new additions to supply for the most part over the last 15, 20 years. So when you buy well-located retail that sits in the heart of town, generally speaking, you don't need to worry about a whole lot of additional supply coming online that's going to compete with you. And if you get it at a good basis, it gives the ability to be flexible and you can negotiate good deals with retailers. Sorry, give me the second part of the question again.
Just kind of when you're doing your leasing, like how you're...
Yeah, got it. Okay. So we're vertically integrated with property management. Our portfolio is nationwide. We have certainly, you'll have vendors that you work with because we're not on site every single day. It's a little bit different from multifamily property where you're cutting leases every day with prospective renters. You'll work with your vendors. You're going to have a porter, guys like that who are going to be there, to make sure everything is operating smoothly. But our property management team, they get typically to the properties several times a year. And then when they go, they'll do a very, thorough run through of the property, speak to all the tenants. They'll spend quite a lot of time on site and put together, very detailed reports that they bring back to all of us. Leasing is a little bit different. So our head of leasing he's fantastic. He's one of the more knowledgeable leasing folks you're going to find. He's been in the industry forever. I probably wouldn't like me saying that. He's been around a long time. Knows everybody, and we've got relationships with all the big guys. But the way that our model works is we want to have a local presence. So he will tag team with a local presence, and he's got some junior guys working for him, but he will tag team with what we think is the strongest local leasing team to ensure that we have a local presence. And we're very thorough in terms of how we vet our leasing partners. But it's just when you think about how we operate compared to how, let's say, like a big REIT or some other institution operates, we think that our approach is much more nimble because, look, we have the relationships with all the nationals, right? All the big guys have relationships with the nationals. But when, if you don't have a local presence on the leasing side of the business, then you're not going to be in the flow of what's happening in the local market. It's really, really hard to manage a center that's, in, I don't know, Orlando from Atlanta, right? Because you're just not in the market every day. Now, if you have, somebody who's really aggressive and, very well connected and really knows what's going on in Orlando, that really aids your efforts. And we've just seen that time and time again in terms of how we approach retail. We can go into any new market. We can scale pretty quickly, and having a local leasing partner that we trust and can really rely on is pivotal to that.
Yeah, it makes perfect sense. I've had a few retail guys on the show here over the last several months. And one of the things, I guess, one of the recurring themes they say is kind of having local partners that they're working with, whether they're doing development there and they're bringing in local people to come on their team, or like you're saying, local people to work out the leasing team. So it's very interesting. It makes perfect sense that you would have that, because it gives you, I imagine it's much easier to rent when you have that footprint there already of a team and partner.
Yeah, it's also, if you just think about, any market you go into, right? You got locals, right? Everywhere's got, you got a local flavor, local feel. It's all a little bit different. You're going to, local movers and shakers, and, people you need to know. And it really, really gives your efforts a boost when you're collaborating productively with, local people who are in the know, as opposed to, going in and, trying to figure it out from square one. Right. And we tend to be, pretty collaborative as a firm. We have, numerous examples of deals we've gone in, and it's not just about leasing. It's also about, building, relationships with, maybe it's local government or, some other, local resource that, you really need to know in order to execute on your value add plan. So having a local partner is really key for us.
Heath, kind of as we're wrapping up here, you mentioned a few different, mistakes that or opportunities that LBX sees when they're acquiring properties. And could you kind of give us maybe a little bit more of a breakdown of maybe some common mistakes that you see retail investors make? And I imagine these are a lot of the properties that you kind of focus on and try to acquire. But what do you commonly see that retail investors, the mistakes they make over your decades in the business?
When you say retail investors, you mean, so if we were buying from...
I'm sorry, retail real estate sector investors, not just like mom and pop investors. Sorry.
Here's some examples, right? And they're not necessarily mistakes. Sometimes they're just, conditions, right? Things that happen. Sometimes you will run into a selling partnership where, there's a fund in the mix and it's end of fund life and they've got to trigger a sale. It doesn't really even have a lot to do with the business plan of the asset. It's more, maybe something else is going on. Maybe it's end of fund life, or maybe they just have to harvest gains for some reason. But anyway, they'll bring an asset to market, and it's not really tied to the business plan for the asset. So we look for opportunities like that. We have found opportunities where companies are being forced to liquidate. Those can be great, right? They gotta, that's a selling pressure. They have to shed assets, right? So, instantly that puts us in a position where, maybe we can be a little bit more opportunistic because they have to trade. We have bought from developers who maybe aren't as strong at operating, or who maybe have, shovels in the ground on, different projects that they need to fund. So that also puts them in a position where they need to, get out of a deal. We bought in situations where the seller, had let's say messed up a local relationship maybe, or just a deal hadn't gone right for them for some reason, but we felt like the real estate was really, really strong. Thinking of some others, and then sometimes it's non-core. I mean, I'll give you an example. So when COVID hit, if you remember, there was all of a sudden the Sun Belt became very, very popular. It had been popular before, and demographic trends had been very attractive in the Sun Belt for a long time. But I remember once COVID hit, there was like an actual theme, right? People were leaving the blue markets, going to the red markets. Everybody was basically going short, short big cities, short areas that weren't sunny and warm all the time, and deploying significant capital to the Sun Belt. And we started off, the first several assets we bought were all Sun Belt assets. Like, we were predominantly focused on the Southeast initially, and so our view was, anytime somebody's like going long on something, that means they're selling out of something in order to do that. And we've just over time found is, a lot of times guys will try to get out of deals and they're really solid deals. So we started looking at markets that were maybe a little bit less glamorous, right? We bought a really great piece of real estate in Fort Wayne, Indiana, right? It's not a huge market. We're not, planning on, buying tons and tons of assets there, but we bought, we felt was one of the best retail assets in the entire market. Because the seller was cycling out of that market and going into other areas. We bought a bunch of really interesting deals in Chicago. Same thing. Chicago, has a reputation. It's kind of unfair in a lot of respects, but we've been able to buy some great deals there, and predominantly because groups were cycling out of the Midwest and looking to allocate elsewhere. And actually, we've expanded our portfolio. We're now nationwide here. We used to be sort of Southeastern focused. Now we own in California. We own outside of Philadelphia. We own in New Hampshire. We own in the Midwest. We can go anywhere that we think is, really good real estate. But it's, all a function of, or not all, but we have several assets that are just good assets that we're able to pick up because, somebody wanted to invest in something else that, they deem to be more in line with, what the street wants, right? So we like to jump on those. We like to play that contrarian theme sometimes.
Interesting. Very interesting. Well, Heath, thank you so much for coming on today. How can our listeners learn more about you and LBX?
Yeah, I mean, our website is www.lbxinvestments.com. People can email me or call me. My information's up there. You email me at Heath. So it's like the candy bar. So HEATH at lbxinvestments.com. And shoot me an email. Always happy to chat with prospective investors.
Heath, thank you so much for coming on today. We'll put that link down in the show notes as well. And looking forward to connecting with you here in the near future.
Yeah, likewise. Thanks so much. Appreciate it.
That's soon.
Take care.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.